This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. Today on the show, I have Harry Dent. Harry makes a return appearance, his second appearance on my podcast. Very objective analysis. Harry looks at demographic trends. It is not my world. That is, in my trading world. I don't use demographics to make decisions. However, I find what Harry does fascinating. I find the analysis of looking at demographic trends extremely interesting. And there has to be absolutely some big macro understandings that you can benefit by seeing his research, seeing where he goes. His new book is called The Demographic Cliff. I find Harry a very reasonable and objective guy. I always enjoy our conversations. I hope you enjoy.
Michael?
Hey, Harry, how are you?
Good.
How goes your morning so far?
Well, I'm super busy last few days. I'm going to Australia for literally almost 4 weeks to promote my book there and to do some speaking tours for a group. And so I've got a lot to do before I leave.
Well, we won't keep you on for no more than a half hour a day, I promise. But the long form stuff is great. You know that you can elaborate. I'll be in Asia actually starting February 2nd for most of the year. So if you're in the region, maybe we can catch up. But let me dig right in. You've got the new book out, The Demographic Cliff. And we spoke before, and I know this is right in your wheelhouse, the idea of demographics. But why, just from a big picture standpoint for people that have maybe not heard you before or familiar with your work, why are demographics so important? And obviously, you've written many books on the subject. You've got the newest one out. It's a complicated subject. You can't give a one word or one sentence answer. I know that. But how do you lead people into this discussion?
Well, the biggest thing is very simple. There's a huge difference between, say, an 18-year-old who's in school being totally supported by their parents at great expense, especially if they're in college, and then a 46-year-old, which for the average household earns and spends the most money and is the most productive in their entire life, and then maybe a 74-year-old that's retired and downsizing everything, spending less, eating less, driving their car less, living in a smaller home. Our life cycle is very important, number one, and of course I've researched that from cradle to grave. We know everything people do, what they spend money on at different parts in their life, but the biggest cycle is very simple. The average person in a developed country like the United States enters the workforce age 20, gets married age 26, has kids around their late 20s, about 28, buys their first home 31, their largest home 41, spends the most money furnishing that home age 46, spends the most on cars age 53, and after that people drop like a rock as they save for retirements, their kids leave the nest. But the magic number for the economy, I found, is age 46 for countries like the United States. When I do work in South Korea, in Japan, it's more like 47. I suspect it's similar to that for Europe. We have more immigrants from Mexico and minorities that tend to peak a little earlier and go to school a little less. But that's it. I mean, in a nutshell, new generations and the baby boom generation exaggerated this in the last boom. They move up this spending cycle in increasing numbers. And in my simplest indicator, which I basically discovered all the way back in 1988, it's just a 46-year lag on the birth index for countries like the United States for the peak in spending of the average household, which is just as quantifiable as when we'll die at age 78.6 these days. And that tells you when the economy is going to boom and bust. And the boom for the baby boom on that indicator was 1983 to 2007, peaked right on cue. And now we have a downturn from 2008 into about 2020 to 23 as Generation X does everything in smaller numbers, buying homes, borrowing, spending everything. And then the next generation, the millennials or Generation Y, will create a boom after that for a couple of decades. But that boom will not be as strong as the one we've seen because that generation didn't have the same kind of heights and births and immigration and everything else that the baby boom did. So this is the most important factor in economics I found for developed countries in the world, and economists don't understand it at all. They just think consumers are Pavlov's dogs, that if you lower interest rates, they spend, you raise them, they stop spending, which is true up to a point. They don't understand that consumers drive our economy. I even link inflation to workforce growth and young people entering our workforce, because young people are expensive to raise until they enter the workforce and become productive. The inflation of the 1970s was not caused by monetary policies primarily. It was caused by the massive baby boom entering the workforce in unprecedented numbers. So we got inflation in the 70s, and then when they fully entered and became productive, we got the greatest boom in history. Now, I can do this in any major country in the world. And the point of this book, The Demographic Cliff, is that the baby boom generation first peaked in Japan in the early 90s when we projected that in the late 80s and went down ahead of the rest of the world while Europe and U.S. had their greatest boom in history. But then the U.S. peaked in 2007, and next, European countries, one after the next, starting with Germany and England, peaked like in late 2013. More and more of these countries are going to go off this demographic cliff. And the Federal Reserve has been desperately fighting this demographic downturn by trying to print money to offset it and not allow this natural downturn to occur.
Harry, let me give you an opportunity to paint an example or a comparison between, let's say, the United States of America, and I'm thinking of three countries that in aggregate probably have a greater population than America. That would be Vietnam, the Philippines, and Indonesia. And those three countries, if I'm not mistaken, their average population is below 50% of the population of those three countries is below the age of 30. So when you have such young countries, such a huge number of people in those three countries, and I'm just picking from example, make a comparison to what will unfold typically in that scenario, and they're still developing to some degree, and then making that comparison to America. What will those kinds of disparities and discrepancies mean for people going forward?
Well, the biggest shift going forward is crystal clear, and economists don't fully get this either. All developed countries, there's a few exceptions like Australia, Norway, and Sweden, that have echo booms that are a little larger than the baby boom. All other countries have a smaller echo boom, and a lot of countries in Europe, in Russia, and East Europe, and Japan have no echo baby boom. So the demographics go sideways at best and decline for developed countries like the United States, and we're one of the better ones. All the growth for decades to come is going to come in these emerging countries with younger populations, and that includes Vietnam, Philippines, and Indonesia. Now, there's another important factor. Yes, demographics. I project workforce growth in these countries because this 46-year lag isn't as appropriate as they don't have the same accelerated kind of earning and spending curves that we have with managerial, professional, technical jobs in the West. But the most important factor in countries like these, in emerging countries, is their rate of urbanization and the higher paying jobs people get as they move from rural to urban areas. So all developed countries are already urbanized. We did that in Europe in the 1800s, in the U.S. in the 1900s, and then Japan and Korea. These emerging countries are anywhere from 20% urban, like in southern Africa, Kenya and countries like that, to typically 40 to 50% urban for most emerging countries. India is only 30%. China's a little over 50%. Philippines would be higher, probably at 60%. But these countries, by urbanizing and shifting people from rural to urban areas, typically the incomes double or triple, and the spending just from this shift without any addition in skills or training and stuff. So we look first at urbanization, the rate of urbanization, how fast GDP per capita goes up. And the problem with the Philippines, they've got good workers, but they don't have a high GDP per capita, 2,000 to 3,000. They are highly urbanized already. They're not going to be a rich country, and that's why so many Filipinos immigrate out of the country and work in other countries. Vietnam is got probably the most potential out of all those three countries because their urbanization is still low and their curve is a little higher. Malaysia is an example in Southeast Asia of a country that is now near fully urban at about 70% and has a GDP per capita between 12 and 14,000. Michael, that's about as high as it gets in the emerging world. Even China projects that they'll only get up to 12 to 14,000 GDP per capita. People walk around and think China's going to be as rich as us. They will not. Only a handful of emerging countries, Korea, Japan, 30, 40 years ago, made the transition to developed countries and entered higher value-added industries. Most of these emerging countries are commodity exporters, and those just aren't that profitable industries and jobs. So, yes, they're progressing, and they will progress. But they are not going to be as rich as us. 7 to 12,000 is about as high a GDP per capita as a fully urbanized, 80% urbanized emerging country gets. And Brazil's another example of that. They're 87% urban and only have 10,000 GDP per capita, 20% of the U.S. So they're not going to get as wealthy as us, but they're going to grow.
I love you because I don't think you sleep. You know way too much about the stats. I tell you, I love talking to you because it's people can argue about opinions and they can say this and that, but breaking it down to the numbers and knowing those numbers, look, that's objective.
Yeah, it is objective. It's a fact. Everything we do, we're projecting predictable things and facts into the future. We're not guessing on politics and saying, oh, we like this or not. And look, there's countries with dictatorships that do well and ones that do horrible. There's democracies that do well and ones that don't do so well, and on and on and on. But we can tell how fast the country's urbanizing, what the steepness of that urbanization and GDP per capita curve. We can project their workforce growth and the number of peak spenders, anything else you want. We can predict the number of car buyers, house buyers, anything well into the future. Why the hell don't economists do this? The answer is they don't do it because they weren't trained to do this. Economists don't study demographics. Marketers and sociologists do. Well, I came out as a business consultant, and demographics was one of the most important tools I had for a lot of new ventures I was consulting to in the early to mid-'80s that were appealing to young new baby boomers and the new trends they were setting. So I studied new technologies. I studied how new trends develop on an S-curve basis and a product life cycle basis, and most of all, I studied the baby boomers up and down. How many of them are there? What do they do as they age? And again, what people do and where they spend money is incredibly different by age. Nothing more important. I was just consulting to a multi-level marketing firm in Australia. Their biggest product is weight loss products. And I said, well, I know why. People weigh the most between age 55 and 60, and that's where the baby boom's headed in the largest numbers in the next decade. No wonder you're doing so well in weight loss. And after age 60, guess what? People naturally lose weight. They won't be as concerned after age 60.
Interesting. Hey, listen, I want to go right into a sweet spot, something you discuss in your new book, The Demographic Cliff. It's been brought up before, but I think it'd be useful for you to kind of go into it. Look, I've been to Tokyo many times. I love Japan. I go to Tokyo, I feel all this energy, but I have a feeling that energy is not exactly real. So you describe it as the Japanese coma economy, and we all know what the equity markets in Japan have done for 20 plus years. But why is what I see in Tokyo sort of an illusion?
Well, their government's doing the same thing we in Europe are doing. They're not letting the massive debt bubble there deleverage, which means the private sectors still have unbelievable debt burdens that are slowing them down. And the government that keeps stimulating has gone from 60% of GDP debt to 250% and rising. This is absolutely unsustainable. They have kept interest rates low, less than 1% on their treasury bonds, their Japanese government bonds, by buying their own bonds and by having all their financial institutions buy their bonds. Only 7% of their bonds are bought by foreigners. So they pushed interest rates artificially low, which allows them to sustain this massive debt. But they're an aging society. Japan was the first to see their major baby boom peak. They're the fastest aging society in the world. And guess who's number two? Germany, who's supposed to hold up Europe. And they got the highest debt ratios private and public, outside of Ireland. So Japan is a bug looking for a windshield, as John Malden says, and there's no way this can work in the future. And the way they're making it work, other than pushing interest rates artificially low and having quantitative easing, which they've been doing now for 17 years, which keeps them from a depression or a debt deleveraging, but it doesn't allow them to grow again. They're just in a coma economy with enough QE to keep them from a crisis and to grow marginally. This is not sustainable. They're a retirement home and hawk as a country, and the only thing they have going for them right now is they do have an echo boom, a small one that's in a positive demographic cycle. They have tripled their stimulus in the last year, which is a desperate move and a dangerous move down the road. But Japan, decades from now, Japan is going to continue to shrink as an economy and global power. And the best thing they could do, have more babies, encourage immigration, which they're not doing, and let the debt deleverage in the private sectors. And they're just not doing it. So they're just going to keep dying. So it is not a real economy. And it's the worst thing I see in the world today. I mean, they were projected to take over the United States in 1989. Now they're 33% of our GDP and falling.
You know, the hard thing I see, though, is, like I said, you know, you go to Tokyo and you don't see the negative on the surface. And so I think the hard thing is I mean, I concur with your analysis, the objective, looking at the numbers. I think sometimes, though, it's difficult because the way governments can manipulate things to necessarily take the objective analysis of where things are going and predict exactly when it's all going to kind of fall in on itself. That seems like the tricky part.
Yeah, well, it is, especially when governments are trying so desperately to stimulate at unprecedented levels, and then they'll just keep upping it and upping it. I mean, you know, that's like taking more of a drug to keep coming down from a high. That never works in the long term, but it does work to a degree in the short term. I tell you where you really see it in Japan and where we see it. You look at the young people. The old people have basically sold out the young people, as happening around the world. The young people don't have the lifetime jobs. They don't have the plush benefits and entitlements. They have more part-time jobs. Young people in Japan, I saw an article, 35% of younger males have no interest, and I mean no interest in sex or dating because they just can't afford it in this new normal for them. 42% of married couples aren't having sex. They can't afford to have a kid. So the young people are the ones that are feeling the brunt of this downturn, and they just have a whole different view of the future. They've lost the Japanese dream. They're just trying to survive and get by. The old people kept all their benefits. So they're not doing as bad. And the government, you know, puts enough stimulus in the economy so they can keep funding entitlements and stuff, but they're not going to be able to fund these entitlements forever. These young people are not going to be able to inherit these debt burdens and these entitlements. In the U.S., this is not going to happen, or Europe. We can't even remotely afford the entitlements we've promised, and it's going to take a global financial crisis, which I see occurring in the next 6 years in this book, for everybody to just look, we're bankrupt. We're not bankrupt long term, but we need a big Chapter 11 restructuring of debt and entitlements, and everybody, Japanese, U.S., Europeans, everybody's going to have to work more to age 75 in line with our rising life expectancies over the last 3 or 4 decades instead of 62 to 65. And we're going to have to continue to raise retirement and entitlements with higher life expectancies. That's the only way to balance out our entitlements, and that's the biggest thing all these countries face. And again, Japan's got no hope of continuing to pay these benefits for these older baby boomers there.
Yeah, but Harry, I think you and I both know these entitlements are never going to get restructured. They're going to fall in on themselves, and then maybe a forced restructuring. Don't you agree?
Yes. It'll only happen in a crisis. It is absolutely not politically acceptable for any politician to stand up and say, hey, we got to transition to retiring at age 75 over the next 10 or 15 years. Now, there are countries like Germany, the second fastest aging, has already raised the retirement age from 65 to 67. So first of all, it may happen voluntarily, slowly over time, but I agree with you. I think there's going to be a major crisis, and we finally just realize when governments get even more in debt and run even huge deficits, we're going to realize we can't get these entitlements, just like corporations and municipalities have had to restructure their retirements because he simply can't pay them. You got to get that point where people realize this is impossible. Then they accept the restructuring. But right now, you're right. No politician's going to get elected saying, I'm going to reduce your entitlements in half.
So I want people to check out the new book, The Demographic Cliff, but I have one kind of heavy question or topic to bring up, something you discuss in the book, and that's the idea of real estate in America. You talk about it, that it will never be the same. Look, we can all see the horror stories that's happened in Detroit. Anybody that's paying attention realizes that, basically 50, 60, 70% of homes in Vegas are still underwater. And that's still in Southern California, Arizona. We're one more crisis away from seeing things just go right back to where they were. No one has any earthly idea how many properties the banks own and what they're keeping off the market. The banks aren't forced to market what they own. It's one big Ponzi scheme. However, clearly there's differences. Like I have a property in the Washington, D.C. area. Thank you, Mr. Government. Property's doing very well. But why don't you talk big picture wise? What's going on in real estate? Why it's never going to be the same, Die-ers versus buyers.
Yeah, this is a huge theme of the book. We've seen generations peak and we see downturns after that, like the 1930s and 1970s, about every 40 years or so. But what is unique this time, and in almost every major developed country in the U.S., Europe, East Asia, is that for the first time in modern history, a smaller generation is going to follow a larger one. So that means slowing workforce, inability to pay these entitlements, all sorts of things. But for real estate, it hits the most because real estate, the unique thing about real estate is that it lasts forever. You've been to Europe and you see homes that have been there for hundreds of years, even thousands of years. So when you get a situation where a larger generation starts to die in increasing number, those Die-ers are sellers. Dead people don't buy homes. And in fact, they have to sell when they die and the homes come back on the markets. When you get to where Die-ers are catching up to or even outweighing buyers, younger buyers, then the real estate market actually can shrink. That you don't have any net new demand. Net demand, I have a new indicator. Instead of a 41-year lag for peak in spending, just like workforce growth, I take the buyers at age 41, the peak buyers, and then I subtract the Die-ers at age 79 in the United States. The net demand for homes after 2013, just when everybody thinks the housing market's recovered, is going to go down for decades. And at a point, I think it's 2033, we actually will have negative net demand, more Die-ers than buyers. So the big thing, banks, and gets back to what you originally said, governments and banks' point of view, God, we can just keep stimulating. Don't force these banks to write down the market or write down these loans or renegotiate with people. Housing will come back like it always does, and then they won't have to write down these loans and everything will be okay in la la land. Real estate is never going to boom like it did in the last couple decades and into 2005. In fact, it may continue to decline. I got onto this when I was studying Japan, and I was looking for real estate to finally turn down after decades when their echo boom came around, and it didn't. It just kind of flattened out. It's still near its lows 22, 23 years later. That's when I realized Die-ers are weighing on the market. And when I recalculated Japan with this model, it says, yes, real estate would be expected to keep going down. It gets a little bump in 2015, and then Japan's real estate will continue to slide for decades to come. So real estate really will never be the same. It's going to go back to, hey, real estate grows with replacement of cost and inflation, like Robert Shiller showed a decade ago. And you buy real estate to live in or to rent for income. You don't sit on it like Jed Clampett and become a millionaire just because you're sitting on real estate. Real estate historically only goes up with inflation at best. We saw an anomaly with the first middle-class generation after World War II, the Bob Hope generation with GI benefits, the first time that people could broadly buy homes and get mortgages in history. And then the baby boom came in record numbers on top of them. So we've had a lifetime of seeing real estate go up more than inflation. That's just not going to happen. So people got to look at real estate. If you love it, if you can make money off it long-term, fine. Otherwise, get the hell out of real estate and into more liquid financial assets where you can actually make money, especially after we see some crashes ahead. But real estate is not going to be the same. And Japan's already proven this. Their real estate's now been down since 1991, when the peak of real estate buying would have occurred there. It's been down for 22, 23 years now and never bounced.
You know, Harry, as we wind up here, I want to make one point. As you and I have discussed what some observers might say, well, gee, Mike and Harry are having this rather negative discussion about the world and economics and whatnot. I should point out that you spend the better half of your book, the latter half, where you basically are very optimistic about when the resets happen and how one can go about doing very, very well. So I don't want people to think in our conversation that we're just having an all doom and gloom here thing. You come out on the other side and you're like, hey, when this all has this reset, here are some great opportunities. And you do go through many different ideas that you have.
Yeah, first of all, Mike, I was the most bullish economist probably in history from the late 80s forward when I got these demographic indicators. I was the only one that simultaneously predicted the greatest decade in history for stocks for Europe and the United States and the worst for Japan at the same time, because that's what demographics do. But also, if you look at these resets throughout history, they're necessary. Housing prices are too high still. That's not good for business, and it's terrible for the next generation trying to have kids and live the American dream again. We have too much debt. The private debt, more than doubled from $20 to $42 trillion, way more than government debt in just 8 years from 2000 to 2008. We need to flush out that debt. That debt is not productive now, is against assets like housing and real estate that have fallen. If we flush that debt out, it'll be painful for the institutions that have to write it down, banks and bondholders and stuff, but it will create a huge cash flow opportunity for businesses and investors. We are going to see financial assets that are all overpriced, not just real estate. Stocks are at a point, if you look historically, if you buy stocks at the valuations and heights today, for the next decade, you're going to make between minus 3% and plus 1% at best. Nobody can make money on investment. If stocks crash back down to affordable valuations, the next generation is going to be able to invest again. So all of this reset is good long term. It will reduce the cost of living, force businesses to get more efficient. They will be able to sell us products at lower prices. Housing will be more affordable. This is the only way to give young people a chance again to clear out this massive debt and financial asset bubble. And the government's only dumbass strategy after creating the greatest bubble in history is to keep the bubble going forever so Humpty Dumpty doesn't fall off the wall. This is the worst policy in history, and it's going to look really stupid in retrospect.
The book is The Demographic Cliff, available on Amazon, available everywhere. Harry, where can people go online to find out more about you?
Well, the best thing we have, Michael, I have a free daily newsletter called Survive and Prosper. A lot of content, everything we're thinking about, current events, new research, new insights. You can get it in bits and bytes. You just go to harrydent.com, put in your email, and you get on that newsletter for free. And then we have dentresearch.com, where you can just find out more information about everything we do and other products we have. But man, you can't go wrong starting with that free newsletter.
Hey, Harry, have fun in Australia. Are you going anywhere else in Asia?
No, I'm going to be in Brisbane, Sydney, and Adelaide, and then I'm probably going back in September to do Melbourne, Perth, and Auckland. So I love Australia. I love the whole area you deal in, Southeast Asia. But this time I'm bringing my wife over at first for vacation, but I'm going to be working most of the time.
Yeah. Hey, Harry, it's always great to have you on, and I appreciate your time today.
Okay, thanks, Michael.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.